Good day, everyone, and welcome to the new year and Equilibrium's first quarterly bulletin for 2026. My name is Robin McLaury, and I'm a business development manager at Equilibrium Investment Management. It is my great joy to be your host today. Thank you for taking the time to join us today and for your continued support for our investment solutions. We have an exciting agenda ahead, but before we delve into the session, let me first address a few housekeeping matters. We have applied for CPD points and expect to receive confirmation from the FBI in the coming weeks. It's important to please watch the full session and add your ID number to the CPD section so that we can verify your attendance. You may also view this event on this platform at any time until the end of March and still receive your CPD points. Our event platform automatically emails you your CPD certificate as soon as you've watched the full session. Lastly, please feel free to ask your questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. Okay, let's kick off this quarter session. Setting the scene, I'm really interested to see what the economic team's views are off the back of a volatile year of tariff wars, geopolitical tensions, and dollar weakness. First up, we have our chief economist, Sanisha Pakrasamy, and our economist, Chiamo Maseke, who will unpack what to expect in 2026. Is it more of the same, or do we see where the green shoots in the new year? Sanisha and Chiamo, we look forward to your valuable insights. Over to you.
Thank you, Robin. Hello, and welcome to our first quarterly broadcast for Equilibrium this year, where we return to evaluate the global and local forces shaping market behavior and investment decisions. I'm Sanisha Pakrasamy, Chief Economist at Momentum Investments. And joining me is our economist, Chiamo Maseke, as we look ahead to the key economic trends that will shape 2026. The year 2026 has begun with a jolt. President Donald Trump's return to the center of global policymaking has brought geoeconomic supremacy back to the fore. Trade is being rerouted, supply chains are being re-engineered, and politics is once again being wielded as an economic instrument of power. These shifts are the legacy of a pivotal election cycle in 2024, when voters across Western democracies rejected incumbents and the political center, ushering in governments further to the left and right. 2 years on, and the realities remain stubborn. Geopolitical rivalry, the need for economic reform, and deepening political polarization have not disappeared. They have intensified. From US policy uncertainty and Europe's fiscal and political fault lines, to China's economic reorganization and South Africa's reform path under a new political configuration, we will explore what this evolving global order means for growth, stability, and investor confidence. Chiamo, it's a pleasure to have you with us today to peek into the economic crystal ball. But before we look into 2026, let us take a step back. At the start of 2025, markets and policymakers had certain expectations, from steady US growth and contained inflation to more stable geopolitics in Europe and Asia. But those forecasts whipsawed during the year, particularly after President Donald Trump's tariff announcements in early April, which sent projections up and down as markets tried to price in uncertainty. Looking back now, what were the biggest political and economic surprises of 2025? And which assumptions did market get most wrong, where reality veered sharply from the consensus?
Thank you, Sanisha. So 2025 was indeed quite a roller coaster, and we had a couple of economic surprises, both economic and political, but I'll touch on a few key ones here. You already touched on the trade tariffs back in April, so that is Liberation Day. I think the biggest surprise to the market here came to the extent of the tariffs. We saw some countries were imposed 40%, almost 50% tariffs. So that massive tariff rate was quite a shock to the market. But over the course of the year, we did see that tariff deals came through and the US effective rate came down. And we also saw what became known as TACO, so Trump always chickens out. But on the back of the tariffs, we did see that growth was revised down and inflation estimates were revised up. And I think this is where the market also got it wrong, because the reality here was that the global economy was quite resilient. So the IMF has economic growth forecast of 3.3% for 2025. And this is an improvement compared to its estimate of 2.8% back in April, so when we had the tariffs. And even with the longest US government shutdown, we did see that the economy was quite resilient. Key factors that contributed to this resilience included the quick supply chain adaptation that we saw. And this is quite interesting because we didn't see the same thing during the pandemic. But there was also major investments in AI, which then boosted economic growth. Another key surprise to the market was the direction of the dollar. So when President Donald Trump was re-elected as the president, it was expected that the dollar would strengthen, but it did the opposite. It actually weakened. So the dollar weakened by 10% in the first half of 2025, and that speaks to how his policies undermined the role of the dollar in the global economy. Another massive surprise was the gold price. It actually surpassed 4,000 US dollar per ounce, and more recently 5,000 US dollar. So this does speak to the increased geopolitical tensions, but also Trump's policies, which are undermining the dollar.
So hang on to that gold jewelry. There's been a lot of talk about the end of globalization, yet the data tells a far more nuanced story. The latest January estimates from the International Monetary Fund suggest that global trade volumes grew by 4.1% in 2025. This was even higher than the 3.6% print that we saw for 2024. Now, if globalization is not dead, but rather reorganizing, how would you describe the economic reordering that is underway for 2026? And which supply chain shifts and new trade deals should investors be paying attention to?
So those IMF trade growth statistics were actually quite interesting. And a part of why we saw trade growth increasing as much as it did is that we had front loading in anticipation of the tariffs. But what we are seeing on a longer term basis is that we are seeing a shift from cost optimized supply chain to resilience focused supply chain. So this can mean that supply chains will now be longer as opposed to shorter, but it will be security for countries, for companies. What we can expect more of in 2026, we can expect more trade diversification. So we will see countries looking into other markets to export their goods, but also looking into a different product mix of the things that they export. We can also potentially see rerouting. We also already saw this with China in 2025, where they were using their Southeast Asian counterparts to export to the United States. So even though trade with the United States decreased, overall, China did have a trade surplus in 2025. Some of the key trade deals that we have to look out for, or rather markets can look out for in 2026, is that Mercosur and EU agreement. So this is between the EU and some South American nations. And what this will do is will essentially cut 90% of the tariffs between the two regions. And this will become, if it passes, it will become the biggest free trade area agreement that we've seen. So you have people who are for this agreement and you have people who are against this agreement. The ones who are for this agreement feel like it should come soon because then these regions can protect themselves against punitive measures from Trump. But you're also seeing that European farmers are saying that their businesses are at risk because then you can't get cheaper goods coming into the country, which will hurt their businesses. Then we have the current US-China trade truce. It's expiring in October, so it will be interesting to see the developments that come through over the course of the year. Trump is expected to go to China in April, so I think the market will also look to see if there are any sides of trade negotiations that happen between the two. But we are seeing that the United States is approaching different countries differently, depending on how much of a threat they pose to the United States. So, for example, China has more political leverage, so they are treated a little bit more differently. Another thing is that we are expecting a ruling regarding the legality of Trump's tariffs. So, what this will do is this will impact only the 10% baseline tariff and the reciprocal tariffs, so not the tariffs that we saw on steel, aluminum, and automobiles.
Well, knowing Trump, there are other tariff loopholes that he can potentially
100%.
manipulate. In 2025, the global story was one of economic convergence. Albeit at a slower pace than in 2024, the US entered the year 2025 with stronger momentum. Europe and the UK lagged, while China continued to grapple with weak demand. But if we fast forward to 2026, we can see that that alignment has now fractured. What do you think pulled these economies onto different paths? And how does the outlook for growth now diverge across the major economies? So, yeah, I'm thinking the US, Euro area, UK, Japan, and China.
Hmm. So, what pulled these economies apart, I think, is the domestic factors started dominating, right? So, the United States was quite resilient in 2025, and it's expected to continue being resilient in 2026. The IMF is forecasting the US to grow by 2.4%, and this is underpinned by strong household balance sheets, but also AI investment is expected to continue, which is also then expected to continue supporting economic growth. The euro area is expected to continue struggling, even with the fiscal stimulus that we are seeing in Germany. So this region is expected to grow at only half of what the United States is expected to grow, so just 1.2% in 2026. Moving on to the UK, we are seeing that past monetary policy tightening and weak investment continues to keep growth below trend. Japan now, we are seeing that there are potential upsides that can happen to this economy. And this is because of the new prime minister and her friendly growth policies. This is not something that we are seeing in other regions. China continues to struggle with demand. Here, weak confidence among consumers, but also the property market is still struggling.
After years of inflation shocks and aggressive tightening, the global monetary cycle turned in 2024. The US and parts of Europe moved gradually. Others eased more decisively, while Japan was still testing whether or not inflation would stick. With growth diverging across economies, how do the inflation outlooks and expected monetary policy paths differ across these markets that we've now just discussed?
So, if we are expecting growth to diverge, then we are also expecting the inflation and the monetary path to diverge amongst the region that we've just spoken about. For the United States, inflation is still expected to remain above targets. So the Fed is anticipating that inflation will be 2.4% in 2026, but also core inflation there is still quite sticky. And we have risks to the inflation outlook. These include the delayed tariff effects, wage inflation, and fiscal stimulus. From a rates perspective, the market is expecting two 25 basis point cuts by the end of 2026. When we move to the UK, inflation there is expected to fall back into the target, so around 2%. And therefore, we're also expecting gradual cuts, so two 25 basis point cuts are expected in 2026. When we move to the euro area, inflation is quite contained, so the central bank there is not expected to move rates this year, so they're expected to stay steady. Japan, again, is our outlier in this regard. Here, they are still tightening to lock in that exit from deflation, so we're expecting two 25 basis point hikes. China, they are going to remain in an easing mode because they are still struggling with that weak demand and excess capacity is driving disinflation.
It sounds like the bulk of that monetary easing really happened over 2025.
It certainly did.
So let's stay with the US. Beyond inflation and growth, markets are increasingly focused on political pressure, fiscal dominance, and the independence of the Federal Reserve. With Fed Chair Jerome Powell now seemingly juggling interest rate expectations and construction overruns of the Fed headquarters in equal measure. What are the key risks to the US interest rate outlook for 2026? And more broadly, how important is institutional credibility for markets in an increasingly polarized global environment?
So the key risks to the interest rate outlook of the United States, I think it's Fed independence. Jerome Powell's term ends in May of 2026, and this opens up a window of opportunity for President Trump to appoint someone in there who is going to be aligned with his view of where rates are and where they should go. Essentially, that interest rates are currently too high and they need to come down. So this does introduce then a risk of aggressive cuts than what is currently being priced in. But with that said, the FOMC, so the Federal Open Market Committee, that structure there is quite decentralized. So you have 12 voting members, and this does then limit the extent to which political influence can impact monetary policy decisions. So it does act as a form of institutional safeguard. Another key risk to the interest rate outlook is possible higher inflation due to increased protectionism. And if this happens, then we can potentially get less than the 2 cuts that are currently being priced in by the markets. But you speak about the credibility of institutions in the United States, and we are seeing that that is being increasingly undermined, right? So if we do see that there's credibility loss, this could lead to further dollar weakness. Inflation pressures could possibly then re-emerge, higher gold prices, and greater volatility in US treasuries.
So, still a bit of risk inherent in that US market. We also know that fiscal stress is becoming more visible across advanced economies. Over the past year, we've seen developed market bond yields rise as markets have now pushed back against heavy government spending and rising debt levels. Which regions or countries look most vulnerable in 2026? And how can these fiscal pressures start to spill over into broader global markets?
So what we are seeing is that the bond market is actually acting as some sort of disciplinary force. So it's requesting higher yields for economies that are actually overspending. So governments that are overspending are requested higher yields. A key example here is France, where their government expenditure ratio is actually one of the highest. And markets have started to punish France. We saw this through credit rating downgrades and higher yields. Moving to the US, we are seeing that there's a lot of political pressure that is keeping deficits above 6% of GDP. There's also a lot of fiscal risk that is still coming through. We have the midterm elections that is still coming up this year, but we're also seeing that there's a lot of support for defense spending. So it does introduce a risk to the fiscal spending in the United States.
Elections in recent years have delivered more polarized outcomes across both advanced and emerging markets, complicating economic reform and weighing on investor confidence. Now, in contrast, South Africa has remained relatively stable at the national level. But how can the upcoming municipal elections reshape local governance and influence investor sentiment?
So, the municipal elections or local government elections are expected to take place between November 2026 and January 2027. And the outcome of that is going to be quite important because municipalities are really there to deliver on the basics. So, the outcome of the elections can have an impact on things like service delivery, electricity, and water infrastructure. We do have some data. So, we have a poll from the Social Research Foundation which has the African National Congress at 37% of support nationally as of November. And then we also have Democratic Alliance at 32%. While now this is national polls and it doesn't necessarily mean that the results will filter through to local elections, it does indicate to us that there is increased possibility of coalitions even in major urban areas. So you have a political analyst that has indicated that the ANC and DA could potentially together secure 60%, between 60% to 65% in most urban areas, apart from Cape Town, which does then reiterate the fact that coalitions are likely. While coalitions can have an increased chances of political fragmentation, but I will say that there is also opportunity in that we can't shy away of. So we can potentially see more fiscal discipline come through. You have key metros, and I think those are going to be quite important to watch out for. You have Johannesburg, Cape Town, Tshwane as the key metros, and they are key from the perspective of GDP, from the perspective of growth, and from the perspective of investments. So, if we do see a shift towards more credible governance and commitment in these metros, this would be viewed quite positively. But then again, if there is renewed instability, it could weigh on sentiment. From a market perspective, what could happen following the election results is that if the coalitions that are formed are deemed quite positive, then on the short term, we can have a positive result on sentiment. But over the long term, the market will look for more evidence based. So they will look at things like, is service delivery improving? Is municipal finances improving? So we will have sort of like the GNU, where sentiment increased, but over the long term, then you are looking for more evidence.
The proof is in the pudding.
Correct.
Structural reform has been a recurring theme in the local landscape. Which areas matter most for lifting growth this year? And where do you think that progress is still falling short?
100%. So structural reform is quite important for South Africa's medium to long-term growth. And I think it also still underpins our economic growth forecast, where we're expecting growth to increase over the medium term. The most important would be in energy, so the energy sector. We have seen a lot of improvement in terms of the generation capacity. So private sector has also come in here and has helped a lot. But the constraint now is on the transmission. The new strategy that was unveiled by government, where they are proposing that generation, transmission, and distribution all fall under one ESCOM holding company, is quite a concern because it's opposite to what was actually promised. So the concern here is that it can actually limit private sector investment into transmission. So we may find ourselves in a situation where we actually get a return of load shedding, but generation capacity is increasing in the country. Logistics remains a key driver of economic growth. Here, we are also seeing operational improvements in Transnet, but also private sector participation. But in this sector, I think we need to see a whole lot more functional concessions come through. Water, I think, is where we need to pay close attention to in 2026 and moving forward. The big national projects are quite progressing quite well. The problem now is at that last mile, so getting water from municipalities to local businesses and to consumers. We know, yes, municipalities do not have a lot of finances that they can play around with, but that infrastructure does need to be dealt with.
Not quite the linear path we would want, but there's a lot of good that you've announced now that I think will actually help South African growth in the longer term. Across the globe, rising geopolitical tensions and shifting power dynamics, especially in the Western Hemisphere, echoing doctrines of the Monroe era, are created a more fragmented international order. South Africa is also navigating this complex landscape. What does this changing global environment mean for trade, capital flows, and policy choices?
Fortunately, South Africa does have a benefit of diverse markets, especially in Asia and the Middle East. But our relationships with the United States are quite strained, right? And they are fragile at this point. So, our role in BRICS, including joint exercises with China, Russia, and Iran, are increasing strain on that relationship with the United States. We saw recently that Canada was actually threatened with 100% tariffs if they sign a deal with China. So what this means is that the US trade policy can now is more depending on politics rather than economics. And this is a risk for countries that are seen as not aligned, such as South Africa. So therefore, South Africa really needs to focus on non-alignment and diversified partnerships. And we've seen other countries do this quite successfully, so the likes of India and Saudi Arabia. Another factor that South Africa needs to focus on in this environment is the appointment of ambassadors and really strengthening that personnel. So, employing more people that are going to be in charge of trade negotiations because we are in that environment that is going to need more of that. From a global perspective, investors are not only looking at economic fundamentals, but they are also looking at political alignment and credibility. So, South Africa is still investable, but it's just that capital is now more cautious globally.
So, foreign affairs playing a far more pivotal role this year. Lastly, looking ahead, South Africa's rand surprised to the upside more recently, supported by a favorable commodity price mix. Now, how might these gains, combined with a potentially stronger than expected fiscal position, influence sovereign ratings and boost investor confidence?
Starting on the fiscal side, so the commodity price windfall is expected to then support corporate income tax. So we are expecting to get higher corporate income tax revenues. That, together with higher value added tax revenues, will then lead to higher government revenue. And in turn, then it will lower the government deficits. So we are expecting that the budget will be tabled on the 25th of February this year, 2026. If the budget comes out with a clear commitment to fiscal consolidation, this will be viewed quite positively by credit rating agencies. For now, we have all three major credit rating agencies, and they all have South Africa as sub-investment grade. But I think the direction of travel is quite positive here, and it's improving. A return to investment grade will likely take time because apart from fiscal dynamics, what the credit rating agencies are also looking out for is improvement in growth, improvement in GDP per capita, but also fixed investment, which we have been lagging there. So we need progress in that regard. From a confidence perspective, we are seeing that investor confidence and business confidence has actually improved. And this is on the back of the improved ratings outlook, South Africa's removal from the Financial Action Task Force grade list, and from the EU high jurisdiction list. The path here, I think we are on a positive path, but it's gradual, so we are not expecting any sudden step change.
So the direction of travel is positive. I think that is a nice key takeaway for our viewers today. As South Africa navigates a more fragmented global order, and with domestic policies under the microscope, 2026 will test how well we balance global pressures with local priorities. Thank you, Tsiamo, for guiding us through these insights today.
Thank you, Sanisha.
Thank you for being with us today. Until next time.
Thank you, Sanisha and Chiamo, for setting the scene and environment for the year ahead. I'm certainly excited to see what 2026 has in store for us. Next, we have Rupert Kissing, one of our portfolio managers at Equilibrium, who will provide context and update to both the global and local markets. Over to you, Rupert.
Thank you, Robin. Good day, everybody. The fourth quarter of 2025 delivered a powerful finale to an exceptional year, where volatility was matched only by resilience. Risk assets not only endured a historic 43-day US government shutdown, multiple interest rate cuts, and record high gold prices, but thrived on them. The quarter cemented a rare achievement, the first time since the pandemic that every major asset class produced a positive annual return. This synchronized global rally, particularly the breakout performance in emerging markets, underscored the resilience of markets during 2025, even in the face of pronounced uncertainty. Global bonds, as measured by the FTSE World Government Bond Index, delivered modest returns during the fourth quarter with a total return of just over 0.1% in US dollar terms. These muted returns reflected investor skepticism about long-term inflation and rising fiscal deficits in developed nations. Full-year performance was solid though, with the index delivering a total return of 7.5% in US dollar terms, significantly outpacing historical averages and complementing equity market gains. Global property had a muted quarter, down marginally at minus 1.1% in US dollar terms, but finished the year in positive territory, up 7.3%. US equities returned 2.3% in quarter four in US dollar terms, while global equities rose 3.1%. The US market remained resilient despite challenges like a cooling labor market and persistent inflation concerns. The AI boom continued to be a primary driver of tech sector growth and overall market gains, though valuations appear stretched. For the past couple of years, the Magnificent Seven, which, as a reminder, includes Apple, Microsoft, Alphabet or Google, Amazon, Tesla, Nvidia and Meta have dominated markets, driving much of the gains in the S&P 500 and global equities for that matter. But in 2025, that momentum stalled, with only two of the Magnificent Seven stocks, Alphabet and Nvidia, outperforming the S&P 500, while the other five companies lagged behind the broader market. The main driver for the two top performance was continued optimism surrounding artificial intelligence, or AI for short. Alphabet's stock surged due to its in-house developed specialist TPU or tensor processing unit chips and AI tools, while Nvidia continued to benefit from strong demand for its more general purpose GPUs or graphics processing units. Heavy AI infrastructure spending by companies like Microsoft and Amazon temporarily compressed their profits, leading to investor demands for tangible returns on these massive investments in 2026. Tesla's stock was highly volatile, underperforming in the first half of the year before soaring over 40% in the second half, as CEO Elon Musk shifted focus from slumping EV sales to self-driving technology and robotics. As we've mentioned in the past, the winners and losers in this race will be determined by who will be able to instill confidence in the market that their capital spending is profitable, and for 2026, those winners were Alphabet and Nvidia. But this by no means means the end for the Magnificent Seven. They remain amongst the most influential businesses in the world. With their earnings growth stabilizing, these companies are becoming cash flow heavy anchors rather than high octane growth engines. The narrowing gap between the Magnificent Seven and the rest of the market signifies a market that is no longer reliant on a handful of stocks to carry the weight of the entire US economy, or global equity returns for that matter, as growth in 2025 was characterized by a healthy broadening in the market. 2025 was the first time in 20 years that the S&P 500 was the worst performing major equity market, as US equities were outperformed by both other international developed market equities as well as emerging markets as measured by the MSCI EM index. Emerging markets experienced strong gains in the fourth quarter of 2025, up 4.7% in US dollar terms. This further contributed to their position as one of the top performing equity asset classes for the entire year, with a substantial 33.6% gain in dollar terms. The rally was largely driven by a weakening US dollar, favorable financial conditions, and resilient domestic demand in many EM economies. South Korea was a top performer for the year, up 99.8% and 27.3% in quarter 4 alone, benefiting from its strong technology sector and corporate governance reforms. Brazil and China also contributed meaningfully for the year, although China detracted in the fourth quarter, down 7.4% in US dollar terms, primarily due to persistent issues in the property sector, weak domestic demand, and geopolitical risks, particularly the ongoing trade tensions with the United States. From a sector perspective, communication services had a good quarter and closed the year out well. The sector gained 3.3% for the quarter and 32.6% for the year, propelled by AI enthusiasm. Secondly, materials. In a year of volatility, gold and silver were standout assets, and resources certainly stole the headlines from a South African perspective. This contributed to it being the second best performer after communication services. Then, financials, industrials, and utilities also emerged as standouts. Industrials and utilities were boosted by the One Big Beautiful Bill Act that passed in July 2025. It provided critical tax credits and restored interest expense deductibility. With the significant rise in AI use and associated data center development, the need for electricity and water also increases significantly. As a result, the utility sector also benefited from this exponential increase in demand. As AI becomes a part of our daily lives, the need for data centers to run the technology continues to grow. In fact, approximately 92% of the US GDP growth in the first half of 2025 was associated with data centers and related AI investments. And without data centers, US GDP growth was estimated at 0.1%, according to an analysis by Harvard economist Jason Furman. And according to S&P Global Research, data centers and associated high-tech spending were responsible for 80% of the increase in final private domestic demand in the first half of 2025. Data centers consume around 180 terawatt hours of power in 2024, and it is estimated that it could double before the decade is out. Add in the electrification of vehicles, and demand is rising faster than utilities can keep up. The Edison Electric Institute, which represents America's investor-based utilities, reports that the industry poured a record $178 billion into the US grid in 2024. That is the 13th straight year of record spending. Over the next 5 years, capital expenditure for these projects are expected to exceed $1.1 trillion. AI has an insatiable need for electricity and water, and it's set to continue growing unabatedly as our dependence on the technology increases. In essence, the AI boom is transforming the US utility sector, potentially creating a massive growth opportunity. So, what does it actually take to power our trusted AI partners on our phones and computers? Have you ever wondered what actually happens when you say hello to ChatGPT or Gemini or any one of the others? Such a simple query might seem trivial, but making it possible across billions of sessions requires significant scale. While exact numbers are not available, it is possible to make some estimates. Consider the following. One ChatGPT query uses 1/5 of a teaspoon of water. So 200 million queries per day will use 2.5 million liters of water, which is enough to fill an Olympic-sized swimming pool every 2 days. Now, how many prompts do you think ChatGPT receives every day? 200 million? 500 million? A billion? Well, if that was your estimate, you can up it considerably. According to estimates, there's approximately 2.5 billion prompts daily. Now, that's roughly 12 times that Olympic swimming pool, which equates to 6 Olympic swimming pools a day, or 31.2 million liters of water. Or, otherwise stated, 11.4 billion liters of water per year, which is approximately 4,500 Olympic swimming pools. As they say, but wait, there's more. This just refers to general prompts. If the task increases in complexity, so does the resources consumption. If you ask ChatGPT to write a 100-word email for you, it will use considerably more water and electricity, of course. The complexity of the prompt has a significant impact on consumption, as well as the location of the data center. A 100-word email being generated out of a data center in Washington will use approximately 1.5 liters of water. This is significantly more than the 1/5 of a teaspoon for general queries. Interestingly, the most data centers in the US are situated in Virginia, which is often referred to as the data center capital of the world. There, 353 milliliters of water is consumed per 100-word email. Beyond water demands, a great deal of electricity is used to power these generative AI models. According to an estimate by OpenAI, every query uses 0.34 watt-hours of energy. If we work on the average number of ChatGPT users and queries according to OpenAI per day, which is 25 queries per average user, and 700 million users, we get 2.5 billion queries. That equates to 850 megawatt hours of electricity required every day, which is enough to charge 14,000 electric vehicles. 2.5 billion queries per day adds up to almost 1 trillion queries each year. 1 year's energy consumption is then roughly equivalent to powering 29,000 average homes for a year, which is 310 gigawatt hours. Though massive, ChatGPT is just a slice of generative AI. Many companies use OpenAI models through the API, and competitors like Google's Gemini are growing. A report from the Schneider Electric Sustainability Research Institute puts the overall power consumption at 15 terawatt hours. Using the report's per query energy consumption figure of 2.9 watt hours, we arrive at 5.1 trillion queries per year. That's equivalent to the annual output of 2 nuclear reactors. And looking at some projections, AI optimists expect the average queries per day to jump dramatically in the next 5 years. Based on the Schneider Electric estimate of overall energy use in 2050, the world could then see as many as 329 billion prompts per day, or 120 trillion per year. That's about 38 queries per day per person currently alive on planet Earth, as per the latest United Nations estimate of 8.6 billion people in 2030. As unrealistic as it may sound, it's made plausible by plans to build AI agents that work independently and interact with other AI agents. And the electricity required to power all of this? While estimates for AI energy use in 2050 vary, most predict a dramatic jump in consumption. This will be driven mostly by AI inference, which is the power used when interacting with a model instead of AI training. This number could be much lower or higher than the Schneider Electric estimate used here, depending on the success of AI agents that can work together and consume energy independent of human input. But using these assumptions, that will be 347 terawatt hours of electricity. Now, how much power is 347 terawatt hours? That is the equivalent of 44 nuclear reactors per year. And just for perspective, 44 nuclear reactors can power between 35 and 44 million households per year, and is approximately 10% of the total number of nuclear reactors currently in operation worldwide. So, 2 takeaways from this. 1, while the excitement surrounding the potential benefits of AI is hard to ignore, neither is the environmental impact, putting massive strain on infrastructure and natural resources. It's really something to think about next time we say, "Hello, ChatGPT." And 2, how it impacts us as investors. The rotation in markets away from the Magnificent Seven is to a large extent still linked to AI. It's just evolved in terms of how it's implemented and leveraged. This includes how companies in all industries, not just the technology sector, use AI to increase productivity and reduce costs, as well as the resources used to drive this tool of ever-increasing importance in our daily lives. Now, back to our market overview and turning our focus to the local landscape. SA nominal bonds continued their rally during the fourth quarter, with the JSE All Bond Index, or ALB for short, up 9%, delivering 24.2% over the last 12 months. The asset class significantly outperformed expectations, and returns were driven largely by capital gains as yields continued to fall, reflecting stronger investor confidence and subdued inflation. The positive momentum was reinforced by an S&P Global credit rating upgrade for South Africa, further reducing risk premiums and catalyzing foreign inflows. From a local listed property perspective, the FTSE JSE All Property Index, or ALP for short, delivered an outstanding return of 16.7% in quarter four, contributing to a total return of around 30.6% for the calendar year. This exceptional performance is the sector's second consecutive year of strong gains. A primary driver was the South African Reserve Bank's interest rate cutting cycle, which brought the repo rate down to 6.75% by November 2025. Lower interest rates reduced funding costs for property companies and improved overall market affordability. The sector also continued to see improving operational conditions, including lower vacancies for retail and industrial properties and stable rental growth. Cash, as measured by the Steffi Composite Index, delivered a steady return of 1.7% for the quarter, equating to an annual return of 7.3%. As a result of the South African Reserve Bank's 2 further interest rate cuts in the fourth quarter, cash yields were on a downward trajectory, making them less attractive than earlier in the year. The South African equity market continued its record-breaking momentum, up 8.9% for the quarter for a return of 42.6% over the past year. In the process, the FTSE JSE All Share Index, or ALSI, hit a new all-time high of 115,844 points in December. The quarter was defined by a rotation from the resources-heavy commodity field rally that drove the majority of returns for the year towards the so-called SA Inc. shares, domestically focused companies that benefited from improving local sentiment and lower interest rates. As mentioned earlier, the South African Reserve Bank cut the repo rate to 6.75% in November. This reduction in borrowing costs significantly boosted the banking and retail sectors. It wasn't enough to propel the industrial sector to overall positive performance for the quarter, though, down 2%. The resources sector delivered a healthy 10.3%, and the star performer, the financial sector, returned 18.4%. Resources was still the best performing sector over the past 12 months by far, delivering a phenomenal 144.2%. Gold saw its best year since 1979, with prices driven by strong central bank buying, safe haven demand due to geopolitical uncertainty and US Federal Reserve interest rate cuts. Platinum also surged over 100% in 2025, driven by supply constraints, improving industrial demand, and speculative buying. The rand continued its strong run and gained a significant 3.9% against the dollar over the quarter. A major driver was broad US dollar weakness globally, stemming from expectations that the US Federal Reserve, or the Fed for short, would cut interest rates further to cushion a softening labour market. The strengthening of the rand had a negative impact on global asset classes for South African rand-based investors and detracted from returns, as global asset classes, with the exception of emerging market equity, delivered negative returns for the quarter in rand terms. A similar picture played out over the past year as the rand strengthened by over 12% for the year. The last time the rand strengthened by as much was in 2009, as the global economy began to recover from the 2008 financial crisis, which also led to a resurgence in demand for commodities and risk assets. As the saying goes, history doesn't repeat itself, but it often rhymes. Despite this, global equities, both developed and emerging markets, still managed to deliver positive rand returns. With more muted returns, global cash, bonds and property, however, delivered negative returns. With the announcement of the country's new inflation target of 3%, with tolerance bands of plus or minus 1% in November, SA CPI inflation ended the year at 3.5%. All South African asset classes, including cash, managed to outperform the new target for the year. Overall, 2025 was another year where markets illustrated the importance of robust, diversified portfolio construction for long-term investment success. While global equities combined with a depreciating rand defined successful multi-asset returns in previous years, strong returns from South African asset classes in 2024 and 2025 managed to offset the impact of the strengthening rand and subdued returns from global asset classes. Thank you.
Thank you, Rupert. Next is Carl Chetty, Equilibrium's Head of Investment Proposition, who will take us through the company's local portfolio performance and positioning.
Thank you, Robin, and hi, everyone. In this section of the webinar, I'll start by unpacking the recent performance of our core model portfolio solutions. I'll then take you through how we're tactically positioning the portfolios to benefit from the expected market environment over the next year. Lastly, I'll chat about several exciting changes we're making to the portfolios this quarter. The most significant one being the change to our SA equity block of managers, which we've reconfigured to deliver a more robust and consistent alpha profile in what has been a challenging market environment for many active managers in South Africa. Kicking off with performance, we show here the trailing returns of our 7 core local model portfolios to the 31st of December 2025, ordered from most conservative to most aggressive. The red blocks represent the targeted investment time horizon of each portfolio. The performance picture looks excellent, with each portfolio delivering returns ahead of their respective return targets over every period shown. Most importantly, the portfolios continue to deliver on their return targets over their respective time horizons, as shown in the red blocks, illustrating the power of our outcomes-based approach to portfolio construction. Zooming into the 3-month returns over the fourth quarter, all 7 portfolios delivered returns well ahead of benchmark, mostly on the back of very strong returns from the SA equity, SA bond, and SA property markets over the quarter. From a peer relative perspective, the returns of Equilibrium Income have lagged the average multi-asset income fund, but there are good reasons for this. The portfolio is deliberately constructed to be a bit more conservative than the average multi-asset income fund because we have a specific risk objective of minimizing the potential for negative returns over rolling 3-month periods. We therefore tend to maintain a lower duration exposure than the typical income fund in the category, and we therefore tend to outperform when bonds are doing badly, and we tend to underperform when bonds are doing very well, as is currently the case. Our previous exposure to the MyPlan IP Enhanced Income Fund also detracted from performance for periods greater than 1 year. The rest of the portfolios pleasingly delivered returns ahead of their respective peers over the quarter, and this was mostly driven by our overweight exposure to local assets relative to peers in an environment where local assets significantly outperformed offshore assets. Most of our local equity managers also delivered market-beating returns in the quarter, which further contributed to the portfolios outperforming their respective peers. Looking at returns for the 1-year period, all 7 portfolios are well ahead of their benchmarks on the back of the exceptionally strong returns we've seen from the local equity, local property, and local bond markets in particular. We did, however, marginally lag peers over the 1-year period, and we'll unpack that further in the next few slides. The exception was the Equilibrium Unconstrained portfolio, which delivered a return of 18.1%, outperforming peers by close to 2% over the last year. To give you a bit more insight into the performance of the portfolios over the last year, we decomposed the returns into their respective return drivers, which are strategic asset allocation, or SAA, tactical asset allocation, or TAA, and manager selection. As always with our solutions, SAA was the main driver of returns. Over the last year, our SAAs delivered exceptional returns on the back of the strong performance from local markets in particular. Over and above that, we also added good value through the TAA calls we made. Manager selection, however, detracted quite meaningfully, and we'll unpack that further just now. If you add up SAA, TAA, and manager selection, and subtract our fee and the residual, you arrive at the total return of the portfolios shown in column F, which ranges from 15% for Equilibrium Conservative and going up to 18.1% for Equilibrium Unconstrained. From a TAA perspective, the call that added the most value over the last year was our decision to be underweight SA cash and overweight SA equity for most of last year. Overall, we added between 10 and 40 basis points in TAA alpha from this call alone. Because we resist taking large, outsized TAA calls in our portfolios, we typically aim to deliver around 25 to 50 basis points of total TAA alpha per year. So we are quite pleased with the results from a TAA perspective. In terms of manager selection, the last year has been quite a tough environment. Although we saw some great outperformance from the likes of Curate Momentum Enhanced Yield, Momentum SA Flexible Fixed Interest, and 361 SA Equity, this was not large enough to offset the underperformance from some of our SA equity managers. In particular, Alet Equity and Fort Equity were the two key detractors across the portfolios. Both these managers have held significant underweight exposures to gold miners over the last year, which was the primary reason for their underperformance. Both Fort and Alet pay no attention to the benchmark in the way they construct portfolios, and both managers tend to avoid allocating too much to resource stocks given their quality approach to stock selection, which causes them to prefer stocks that are able to compound consistent earnings growth every year. And as we know, the earnings profile of resource companies tend to be quite volatile and cyclical. Although Alet and Ford underperformed quite significantly over the last year, the truth is that the vast majority of active SA equity managers underperformed the index last year. This is because the only way to have outperformed is if you have held overweight positions in gold and platinum miners, which now comprise a massive 25% of the index. From a risk management perspective, very few active managers will hold more than 25% of their fund in gold and platinum, and thus would have underperformed over the last year. Over the next quarter, we will be making a few material changes to our SA equity blend of managers, and I'll unpack that further later on. The other key detractor in the portfolios over the last year was the Visio Unconstrained Fixed Interest Fund, which we use as part of our SA bond execution. The fund is quite conservative in terms of its duration profile and therefore struggled to keep up with the massive rally in SA bonds last year. So we actually expect Visio to underperform in strong bond bull markets like the one we've been in. The other fund we use for SA bonds is the Momentum SA Flexible Fixed Interest Fund, which allocates segregated bond mandates to 91, Coronation, and Prescient. This fund is more aggressive than Visio and outperformed the All Bond Index last year, helping to offset some of the underperformance from Visio. In terms of tactical asset allocation, there are three calls we would like to express in the portfolios. The first is to be underweight SA cash in favor of SA equities. The second is to be underweight global bonds in favor of emerging market equities. We initiated both these calls last quarter and will continue to maintain these positions in the portfolios. In our view, both SA equities and EM equities continue to trade relatively cheaply despite the significant rallies we saw last year. The third call is to be underweight cash in favor of SA bonds, and that's a new position we'd like to express in the portfolios this quarter. Despite the strong performance from SA bonds last year, real bond yields in SA are still quite high compared to our emerging market peers and compared to our own history, indicating that there's still some support for SA bonds going forward. We've also seen renewed interest in SA bonds by foreign investors who were actually net buyers of our bonds last year, and that should provide further support going forward, especially if inflation remains relatively contained. Moving now onto the manager changes we'll be implementing this quarter, and starting with South African equities. The last few years have been a particularly challenging period for active managers aiming to outperform the local equity market indices. The chart here shows the proportion of SA equity funds with no offshore exposure that outperformed the Cap Swix index over the 1, 3, and 5-year periods to the end of December 2025. 21% of funds outperformed the index over the 5-year period, 17% over the 1-year period, and just 11% over the last 3 years, not a great outcome for the active management industry. The chart on this slide demonstrates the same point. It shows the rolling 3-year returns of the average SA equity fund versus the index over the last 5 years. And as can be seen, periods of positive alpha have been quite fleeting. The average manager underperformed the index during 2/3 of the rolling 3-year periods over the last 5 years. And when they did underperform, the underperformance has been quite severe. In the most recent rolling 3-year period, the average manager underperformed the index by close to 7% per annum. But why is this the case? What are the factors that make consistent alpha generation on the JSE difficult for active managers? And how should we, as a DFM, respond to these dynamics in our client portfolios? There are a number of factors that have converged to hinder the ability of active managers to generate consistent alpha on the JSE. Firstly, the JSE has been shrinking. It's undergone a dramatic decline in the number of listed stocks, from over 1,300 in 1997 to just 270 in 2025, creating a much smaller investable universe from which to pick outperforming stocks, especially for managers that follow a pure style approach. This wave of delistings, combined with foreign investors being underweight South Africa, has reduced market liquidity. Additionally, the higher offshore allowance for Regulation 28 compliant portfolios has also unintentionally lowered local equity trading volumes, weakening liquidity further. And liquidity is crucial for active strategies. And when it dries up, it becomes more difficult to implement alpha-seeking trades at scale. Adding to the complexity, mid and small cap stocks, traditionally quite fertile ground for alpha, now represent a smaller slice of the all-share index, and this further limits the number of alpha-generating opportunities. The result is a market that has become significantly more concentrated and cyclical over the years. Performance has also grown increasingly polarized, with stark differences in returns across sectors and stocks. This makes consistent alpha generation harder. Furthermore, traditional style biases such as value, quality, and momentum fail more predictably in highly cyclical, macro-driven markets. Given these changes and challenges, the implications for manager selection and portfolio construction are critical for DFMs that aim to harness consistent alpha on the JSE. And we believe that active managers with the following attributes are the most likely to succeed. Firstly, having an awareness of the benchmark is important given the concentration and cyclicality of our market. For example, avoiding key sectors such as gold and platinum mining companies in 2025 would have severely hurt investment returns. Secondly, managers that are more flexible with regards to their style have a better shot at generating consistent alpha. Narrowly following a value or quality approach, for example, further reduces the already shrinking investment universe. Thirdly, managers that are too large in size relative to their own investment process will miss out on opportunities, especially in the mid and small cap space. So it's important that a manager is small enough to access the full opportunity set with respect to their investment process. Fourth, given the very cyclical nature of our resource-rich market that is highly sensitive to global dynamics, managers that combine top-down macroeconomic analysis with bottom-up stock picking should be better equipped to pick winning stocks in any given market environment and cycle. And lastly, managers with a hedge fund mindset that have the ability to sell stocks just as well as they buy stocks have an advantage in our market. The tendency of some managers to get married to their investment ideas can be especially dangerous in our small, concentrated market. In order to reflect this thinking in our client portfolios, we have already embarked on a journey over the last few quarters to change the way we construct our SA equity block. We've always adopted a style-based approach where we aim to solve for specific exposures to the three primary styles in SA, which are value, quality, and momentum. Historically, the way we executed this was through a large core allocation to style-focused smart beta funds. coupled with a few active managers, as shown by the pyramid on the left. However, with the South African market shrinking in size and with the benchmark becoming ever more concentrated, funds that follow a pure style approach have struggled to generate consistent outperformance. So our approach now is to lean more towards active managers that are not tied down to any specific style, go where they see the opportunities, consistently make good decisions, and that have some regard for the benchmark in their portfolio construction process. As the pyramid on the right shows, these active managers will now form the core of our blend. Through our advanced quantitative tools, we analyze the blend of styles we pick up from these managers over time, and then we fill in the gaps with smart beta exposure in order to arrive at our ideal long-term split of 40% momentum, 35% value, and 25% quality. So in our new approach, we've inverted the pyramid so that active becomes the core, while we use style-focused smart beta strategies to complete. Our new blend looks as follows. 88% of the blend will now be allocated to 5 active managers and just 12% to smart beta. Most of the active allocation is distributed across 4 managers that have an awareness of the benchmark in their process and that are not tied down to a single investment style. These managers are Fairtree, Lorium, which we access through the Ned Group SA Equity Fund, 361, and Truffle. The last active manager is AILIT. AILIT mostly follows a value-based approach and doesn't pay much attention to the benchmark. However, it's one of the few active managers in South Africa that give you meaningful exposure to the value style over time. But given the benchmark agnostic nature of the fund, we are reviewing its appropriateness in our blend and are researching potential replacements. Lastly, we've included a minor 12% allocation to the Momentum Trending Equity Fund, which is a low-cost, smart beta strategy that captures the momentum style in order to ensure we achieve the optimal 40% exposure to momentum through a full market cycle. And in order to execute this new blend, we will fully exit our remaining exposure to the Foort Equity Fund, and we'll sell our entire exposure to the Momentum Core Equity Fund. These are funds that we've held onto for a number of years now. So in order to manage any potential CGT implications for clients who use the portfolios in discretionary products, we will execute the changes in March so that it happens in the new tax year. The charts here show the back-tested performance of the new blend versus the index over time after fees. The chart on top shows the trailing returns against the peer group divided into quartiles. The new blend is in blue while the index is in red. And as you can see, the new blend didn't materially underperform the index over 1 year and 3 years. And it's outperformed the index over 5 and 7 years, whilst also delivering first quartile performance. The chart below shows the rolling 3-year returns relative to peers and the index over the last 5 years. And as can be seen, the new blend either outperformed or delivered returns in line with the index over almost every single rolling 3-year period shown, and also delivered first quartile performance over most of the rolling 3-year periods. And this is a great outcome for what has been a particularly challenging period for active managers in South Africa. Moving on from SA equity, the next change we will implement this quarter is with respect to SA bonds. We currently execute on SA bonds via an equal allocation to the Momentum SA Flexible Fixed Interest Fund and the Visio BCI Unconstrained Fixed Interest Fund. The Momentum Fund is composed of 3 underlying segregated mandates managed by 91, Coronation, and Prescient. The fund is quite benchmark aware and aims to outperform the All Bond Index by about 1% per annum over time. It has the ability to go both overweight and underweight duration relative to the All Bond Index. The Visio fund is much more conservative in nature, especially from a duration perspective, as it tends not to exceed 4 years in duration at a portfolio level. Given our view that there is a good chance that SA bond yields continue to fall this year, we are increasing the allocation to the Momentum SA Flexible Fixed Interest Fund from 50 to 75%, as the fund's mandate gives it the ability to outperform in a falling yield environment. We are also reviewing the ongoing allocation to the Visio fund, as it may be too conservative for the environment we expect going forward. The final change we are making to the portfolios this quarter is with respect to emerging market equities. We currently execute using two funds, the Coronation Global Emerging Market Flexible Feeder Fund and the Curate Global Emerging Market Equity Feeder Fund, an enhanced index fund managed by Rubico Asset Management based in the Netherlands, which we started buying last quarter. The current split is 83% to Coronation and 17% to Curate. Our ideal split, though, is a 50-50 allocation between the two. The Coronation Fund is very benchmark agnostic, while the Curate Fund is very benchmark aware. And we find that a 50-50 split between the two positions the blend to deliver an alpha signature that is more consistent and less volatile. So this quarter, we will complete the transition to a 50-50 split. In closing, here's a summary of the actions we are taking this quarter. Firstly, in terms of TAA, we'll continue to maintain overweight positions in SA equity and EM equity. And we will also initiate a new overweight position in SA bonds, which will fund from SA cash. From a manager selection and portfolio construction perspective, the third change is to execute our new ideal SA equity blend, which involves completely selling out of Foot and Momentum Core Equity, and buying the Truffle SA Equity, Momentum Trending Equity, and Nedgroup SA Equity funds. The fourth change is to reduce the split to Visio unconstrained fixed interest by half, in favor of the Momentum SA Flexible Fixed Interest Fund, which is managed by Coronation, 91, and Prescient. Lastly, we will reduce the split to Coronation Global Emerging Markets Flexible in favor of Curate Global Emerging Market Equity, which is managed by Rubico in the Netherlands. And that wraps up our section on the performance and positioning of the Equilibrium local range of model portfolios. Over to Robin.
Thank you, Carl. For Bella Yates, Managing Director of Equilibrium, is up next, and she'll be hosting a panel discussion with some of our investment management partners. Welcome Justin Ritchie from Alet, Etienne Roux from Truffle, and Junaid Bray from Lorium, who manages the Nedgroup Investments Equity Fund. They will have an interesting discussion around the secrets to consistent alpha generation on the JSE.
Thank you, Robin. Last year was a great year for South African equities, yet the divergence in asset manager performance was quite large. If we look at the slide, you can see that regardless of what index you're using as a proxy for South African equities, all of them gave you over 40% returns for the year, way above what they have done over the 3, 5, or even 10-year periods. South African resources delivered a whopping 126% return last year, with platinum being the biggest contributor and gold doing really well. As a discretionary fund manager, our role is to construct diversified portfolios and to ensure that our asset class building blocks perform throughout the cycle. In our local equity building block, we use a combination of active, passive, and smart beta strategies. We also select managers with different investment styles. On our panel today, we have 3 of our active managers. Starting on your far right, Junaid Braid from Lorium, who manages the Nedgroup South African Equity Fund, Justin Ritchie from Alet, and Etienne Roux from Truffle. All 3 portfolio managers have had huge experience and have been included in our portfolios over the course of a number of years. It's an absolute honor to have all of you on the panel and share space with you. This slide shows the top 10 holdings of each of the funds managed by these 3 portfolio managers. You'll see where the overlap exists. So the first rand is the only stock that all 3 portfolios hold, but then there'll be overlap between different funds. Anglo America, for example, is held by both Alet and the Nedgroup Fund. And you'll see there's quite a large overlap between the Nedgroup and Truffle funds with Naspers, Anglo Gold Ashanti, Goldfields, First Rand, Absa, and Valera Platinum. And then Standard Bank is held by both Alet and Truffle.
You'll also notice that Nedgroup and Truffle funds are South African equity funds, whilst AILIT has a more global equity mandate with us. So it's no surprise that AILIT has the least overlap with the other managers. I'd like to give each of you an opportunity to quickly explain your investment philosophy and what factors you look at when you're selecting stocks. So Junaid, let's start with you.
Sure, thanks, Fluff. Thanks for having me on the panel. So I think at Laudium, I think we are fundamental bottom-up investors and we follow a valuation-driven approach. And so what that means is when it comes to stock selection, we really focus on, from a bottom-up perspective, valuing the companies, looking at the cash flows, and then selecting ideally, better quality companies. But at the same time, when we see upside on the stock and we see a risk skewed to the upside and we try to minimize the downside risk, those are the kinds of securities we like to select and include in our portfolios. And then at the same time, we also apply a macro overlay. And given our hedge fund background, we do see special opportunities arising in the market. We'll take advantage of those in the fund as well.
Can I ask you what you look for when you say quality companies?
So ideally, companies with strong cash flows, good management teams, strong balance sheets, a good franchise or a good moat. But, at the same time, our South African market's quite narrow, so we don't try to box ourselves in it as only focusing on quality. There are ample opportunities in the value space as well. We've got conviction on a company either turning around operations or being incredibly undervalued, and we see minimum downside risk. We take advantage of those as well.
Great, thank you. Justin, in a global mandate, how do you decide between SA Inc. stocks and attractive companies in the offshore space?
So we don't really think of the world in terms of silos. So we're doing fundamental analysis on an asset by asset basis, building cash flow forecasts to get to an intrinsic value. And then we look at intrinsic value relative to where that stock is trading. There's small tweaks between the discount rates that we use in South Africa and offshore. So a risk adjustment depending on the asset we're looking at. But we build the portfolio stock by stock from the bottom up based on the opportunity set that we see in the market at one time. And then obviously within mandate levels or mandate restrictions, we will look at the resulting portfolio and assess concentration risk, sensitivity to interest rates, too much exposure to a particular currency that we don't like the risk in. So, if you look at the portfolio today, we're somewhere in the range of 25% of the portfolio is sitting offshore stocks. 40% is in SA Inc. So it's not, we don't wake up and say we want X amount of South Africa, X amount of something else. It's based on the opportunity set that we see in the market.
Great, thank you. And Etienne, your turn.
Thanks for Bella. I think we believe the market is efficient over the long term at valuing companies, but there can be a lot of inefficiencies in the short term, where if there's good news or bad news, the market typically over-exaggerate those news flows on the upside and the downside. So we believe if we follow our process consistently and we use our experience in our team, we can take advantages of this difference between what the market is prepared to pay for a share versus what we think the intrinsic value is. So like a perfect investment for us would also be like a great company, like Junaid said, but that's facing some sort of temporary setback. So it's also a very thin line between what is temporary and what is structural issues for that setback. So if we can find some of those opportunities where there's a temporary setback and the market takes a negative view on that, we can get the opportunity to buy into those companies at a discount to what we think it's worth. And I think the last thing from our point is also we've put a lot of emphasis on downside protection. So we've got a unique focus on just avoiding the risks, avoiding the bombs. So we believe outperforming the market over time is not just about picking winners, but it's just as much about avoiding those losers. So we put a lot of emphasis on that, and we believe if we get that right, we'll be able to outperform in the longer term.
Great, thank you. As you can see, they each have their own distinct investment philosophies, and although they're quite different, there's still quite a lot of overlap in their top 10 shares. Now let's get into some of the detail. Junaid, starting with you again, you had quite a lot of gold and platinum stocks. Can you talk us through why you hold these and also whether you believe they'll continue to perform or whether you're looking to downweight any of them in the current environment?
So when we construct our portfolios, we aim to avoid taking unwanted excessive factor or sector risks. And what that means is, from a sector perspective, when you have large sectors or large stocks in the market or in the benchmark, we'll try to avoid unwanted large excessive risk away from that. So if I look at the gold sector, it's grown. We know what as you opened up talking about the gold price and what it's done. It recently crossed $5,000 an ounce. So gold's become a very big part of our market. So we would own gold in our portfolio. So ordinarily, gold is a very difficult metal or commodity to have high conviction on because it's traditionally largely sentiment driven. That being said, in the current environment with the heightened geopolitical risks, it's very difficult to make a call against gold, given everything that's happened. And for that reason, we continue to hold gold in our portfolio, but we have been taking profits on it and using that to buy some of the more undervalued opportunities where we're seeing better upside on a risk-adjusted basis. And most of them tend to be in the domestic space, which has lagged. On the PGM side, I think it's a bit different because there it's more fundamentals from a supply and demand perspective as a traditional commodity. You can apply that more in the case of PGMs, largely from the likes of auto catalysts for cars. And we've long held the view for a while now that the battery electric vehicle forecasts were way too optimistic, and it would have been very difficult to implement those practically. And we felt that ICE and hybrid cars were going to be with us for a lot longer. And that would underpin the demand for PGMs. And for that reason, we held PGMs in our portfolio. In fact, we took some pain holding it in the last probably 2-3 years. And that's paid off now. And we continue to hold. We still think that there's still upside. And I think the precious metal component of platinum, particularly as a secondary precious metal to gold, is also supporting demand for platinum. So that's also driving it a bit higher. But we continue to be quite positive on the outlook for PGM still at these levels.
Thank you. And can I ask you one question? I know we've discussed it before, but maybe for our viewers, why would you hold a gold stock rather than just buying the gold ETF if you were just wanting some exposure to the sector?
So bringing it back to the company and cash flows. So that's a good question, Fluff. From a positioning perspective, I remember we fundamental bottom-up investors, and we preferred Anglo Gold and Goldfields as our picks within the gold sector, and particularly Anglo Gold. We had a big position there because we felt that despite the company being of reasonable quality within the gold space in terms of cash flows, the operations, the balance sheet had no debt on it, and they're quite geographically diversified also. And we felt that the market wasn't giving them full credit because they had a bit of a mishap about 2 or 3 years ago in one of their operations, and the market was kind of penalizing them, trading at a slight discount. And we felt there was upside to re-rate to one of the better quality gold companies, and that was our fundamental reason for owning Anglo Gold, particularly when we had a big position there. And then in the PGM space, also bottom-up fundamental stock picking. We had preferred Impala, and we had quite a lot of Northam, and we've used the opportunity with Northam's outperformance to actually switch that into Valterra, the old Anglo-American Platinum. And we used the opportunity of the placement when Anglo-American sold down. We used that as an opportunity to increase our exposure to Valterra. So it was largely fundamental bottom-up, but with a positive view on the underlying commodity.
If I can maybe add for business, so just on, I think it's actually a very good question at the moment because we've also had the view of owning the equities over metal for the last number of years, really. But I think as the gold price has gone up so much, at these levels, the leverage you're getting on the gold shares is a lot lower than what it was a few years ago. So at $5,000 plus, you're not getting that big leverage that you had before. So I think the metal is starting to make a lot more sense in terms of, when if it were to fall, metals are going to fall as much as the gold shares. There's a lot of good news, I think, also priced into that market. But I think that leverage you got in the past on owning the equities, that is diminishing quickly. So
does that mean we can expect you to start selling out of the equities and buying the ETF?
We're also selling equities, like Junaid said, similar view. I think we think end of the year, there's a lot of crazy stuff that's happened over the last few months. So I think there's a lot of good news priced into the gold. It's difficult to say what is priced in, but we think there's a lot of good news. And into the end of the year, when you go to the midterms elections in the US, we think eventually this craziness is probably going to slow down a bit. Maybe if some sanity comes back in the US market, in global markets, we think that's negative for the gold price. So we got a similar kind of, I think, positioning as what Janae's been saying.
Yeah, thank you.
Yeah.
Okay, Justin, you and I have chatted a lot about your view on gold stocks. And I know that in the past you've mentioned you find it difficult to value gold companies. Can you maybe explain why that is and what you're doing now? As the other two gentlemen have said, it's a big portion of the index.
Yeah.
So when you don't hold it, it obviously can affect performance.
Yeah. So not owning gold at the moment is a very unpopular opinion. We've never owned gold in the history of the firm. And I think just important to say that it's not something fundamental we have against gold. If it appeals to an investor, it's their prerogative. We do bottom up cash flow based valuations, and gold resists that type of analysis because we don't really have a confidence in our ability to forecast the gold price over pretty much any period, short, medium, or long. So when you don't have an opinion on the gold price, it's very difficult to put a range of value to the equities. So we've decided to spend our time and deploy capital elsewhere, which at the moment clearly looks like the wrong call. But we're confident, through the cycle, the process will play out and we'll be able to perform.
Okay, Etienne, your portfolio has had several banking stocks, First Rand, Absa, Standard Bank, and Capitec. It's unusual to see so many of the banks in the top 10 holdings. Can you talk us through your thinking behind that?
Yeah, so I think firstly, if you think about the macro, I think we're coming into 2026, we're quite positive on the domestic macro environment. Clearly, these gold prices and all these metal prices that's so high is very, very positive for our economy. So you can think bigger tax collections, our inflation is pretty low, there's going to be more rate cuts, our fiscal position for the country is going to look better. So we've got very strong tailwinds at our backs at the moment. Also, all the crazy stuff that Trump and the US is doing is also good for us in emerging markets in South Africa. So I think from the first point is we're quite positive on the domestic environment, and we also don't think our valuations are expensive relative to history. I think then if you go into, we still don't think it's a shotgun approach where you can just buy any SA Inc. shares and it's going to do well. We think it's got to be more selective in certain sectors and certain companies. And I think our view on the banks, there's three kind of reasons. I would say we've got conviction, I think, around the total returns of dividend yields plus earnings growth of about 15%. And that's very compelling versus our bonds that's currently at close to 8%. So we think that's a very good opportunity and it's very attractive returns. I think that's the first point. Secondly, I think our conviction around the earnings for the banks is very high. So we've got very good conviction in the dividend yield is obviously what it is, and we've got very high conviction around the earnings growth numbers. So we think that total return number of 15% is very doable and very compelling. If you compare that to some of the retailers, for example, we're just a bit nervous in terms of discretionary spend in South Africa. It's still very weak. It doesn't seem to be improving. And we just worried a little bit about some of the potential structural issues or risks in the discretionary retail space. So I suppose, so I think the banks is for us just a safer way of playing this SA Inc. trade. I think thirdly, as I said, the consumer environment is still very weak, but there's a lot of activity and the corporate loan growth in South Africa is actually very strong. So the banks benefit from that, where the retailers, for example, doesn't get that exposure. So if we put all that together, we've had this view of banks over, I suppose, retail over the last 12 months, which have worked quite well. I guess the question is starting to come in, at what point do you shift some of it? We just don't think we're at that point yet. So we're still happier owning the safer. We've got line of sight and conviction around the total returns relative to some of the other SA Inc. companies.
Great. Thank you. 3 very experienced portfolio managers, and you can hear how they think about picking stocks. Now, we know that all good managers have periods of underperformance. So this time I'm going to start with you, Justin. And what worked against you in the last year? And is there anything you're planning on doing differently this year?
So I think the first thing to point on, you opened with it, was last year was very unusual. Very strong index return, but coming from a very narrow part of the market. And when you run portfolios that look very different to the benchmark, there are going to be periods where the performance diverges, especially when that narrow part of the market runs and you don't have exposure. So last year we don't own any Naspers Prosus, which is big in the benchmark, and that did fairly well last year. As we discussed, no gold exposure, which was a big detractor, and unfortunately We do have exposure to PGMs, but it wasn't enough to compensate for the first two. I think it's very interesting when we look at the attribution relative. Our offshore stuff, we think, did quite nicely last year. So if I look at our global fund and the stuff that we own directly offshore, it handily beats, say, S&P 500. It beat a global index like ACWI, but was a big net negative relative to South African index. In terms of doing things differently, I think, when a narrow part of the market runs like we saw, that can create kind of a should-have mentality within the team. And our job is to make sure that we don't start doing things that are ill-disciplined. We have a process that works, and it's been proven over multiple decades. Our job is to stick to the process. We're always trying to tweak the process. There are things that we get wrong and that we're not doing properly. But the big stuff, we think would be crazy to change now. And, to go and do big shifts and swing the portfolio just to chase last year's winners, I think would be the wrong call.
That makes me very comfortable. Thank you. So those of you who've been invested in our portfolios for a long time will know that we blend a building block. We like managers that look different, and none of us sitting here have a crystal ball, so we don't know what's going to run and what's not going to run. And so it's important to build a truly diversified portfolio and have different stock picks in the portfolio. And also the weightings that we give to each asset manager is very important, which is why we can stomach periods of underperformance from any managers. And obviously all good managers do have those periods where they lag. And so we're not forced to sell out of a manager in reaction to a short-term underperformance. In fact, there can be times of longer-term underperformance. As long as you've got the right weighting, you can actually stomach it. But what does make you comfortable is when you're choosing a manager, what's on the tin is what you get inside. So it would make us very uncomfortable when managers start changing their philosophy and start trying to pick stocks that they wouldn't normally pick just because performance is lagged. So thank you for that. How about you, Etienne?
No, so our biggest detractor last year was MTN. So I think, we were under, 2023, 24, we thought we were heroes when the share price went down like 50%. And it just come back from like 75 to like where it's today, like 175. So that's hurt us quite a lot in the last 12 months. I think two big things changed in MTN. So the Nigerian and Ghana operations countries, two of the core countries, had a much improved macro environment. So with the gold prices and commodity prices, they benefited significantly from that. Like we're seeing in South Africa, some of that at the moment. So their currencies was a lot stronger. Ghana currency went 30-40% stronger, and Nigeria also kind of stabilized and strengthened a little bit. So that flowed into improved margins, improved earnings that flows through to MTN. I think that was the one big thing, that the macro changed in those countries. I think the second thing that changed was that they had a very significant tariff increase in their telcos and data services, which offset a lot of the margin pressure they had in the previous years. So those two things was very material and flowed into MTN's earnings, improved investor sentiment, etc. So that was a big underperformance for us. I think some of the justice said we're not going to change our process. We're not going to change our thinking around what we do. I think as a manager, we know that we just have to we're going to get a lot of shares wrong. We always get a lot of shares. There's always stuff you get wrong, and we make peace for that. And I think we just have to try and make more good decisions rather than bad decisions. Yeah.
Thank you. Junaid, I'd like to give you a turn.
Yeah, so from our side, I think what detracted from performance last year was really some of the shares we didn't own that had performed very strongly in the benchmark. So some of the lower quality gold names, some of the low quality PGM names we didn't own, the likes of Sibanye, Harmony, which we didn't own. And then also we didn't own enough MTN, similar to what Etienne said there, and Capitec, which also performed quite strongly. And then I think what we did own that detracted, I think we were maybe a little bit too early owning some of the retailers. So I think some TFG had underperformed quite a lot with earnings downgrades. And I think the earnings base or the sales base for some of these retailers are very high for the year 2025. So I think we're going to start cycling into softer bases. And also, as Etienne mentioned, we agree that that some of the macro tailwinds domestically are incrementally looking better from a fiscal perspective, etc. And so I think lower interest rates, etc. And I think you're going to start seeing that coming through. And we've been selectively adding to some of them where we feel there's a lot of upside not baked in, the likes of Mr. Price and Shoprite.
I'd like to ask one more question around your selection. You all earn first rank. I'd like to know your reasoning, each of you, for owning that stock, given that you have different investment philosophies.
So going back to what Etienne said earlier about the banks in terms of early beneficiaries from a macro perspective and having conviction on your expected return because it's underpinned by strong dividend yields. So I think we quite like the banks. And then FirstRand particularly, I think it's a very high quality bank from a franchise perspective, and you generate very high ROEs in north of 20%. And I think it's very well run and conservatively run. So you never really have big credit blow-ups with FirstRand. And then I think, we started accumulating a lot more when the Aldermore, the UK division, there was the motor finance claims issue, and the market over-penalized it for the expected provision that they were expected to pay. And it's only 10% of the business, so 90% of the business was being penalized by that, and we use that as an opportunity to increase our position, and that's why even where it is at the moment, we still see FirstRand as one of our bigger bank positions in the fund.
I don't have a lot to add. I think Jeanette's covered the main points. We are admirers of the business and the management. It's been well run for a number of years. It's been in the fund for many years. We think it's probably the highest quality of the South African banks. We do own some Standard Bank and some Nedbank as well, but FirstRand is, I would say, the highest quality of the bunch.
So we're only in the top 10, but we're actually underweight slightly at the moment. So obviously it's big in the weights in the index. That's why it comes up in the top 10, but we're slightly underweight. And we've also been trimming a little bit in the last month or so. Purely just on valuation basis, really. So the banks have run really hard. We still, as I said, we still like the banks, but relative to the other banks, we thought it's done very well. Valuations are not that attractive relative to some of the other banks. So we're slightly underweight. I think we've got a preference for Absa at the moment. That's probably our biggest overweight in that sector. And then we've increasingly been buying some Investec. So Investec I think it fell through the wayside a little bit, or through the cracks, because it's not a pure SA bank. 50% is UK, 50% SA. So investors in the last 12 months was looking for SA Inc. exposure. So we've been buying the SA banks, and it's lagged significantly, about 20-25% to some of the banks. So we see that as being really cheap at the moment, very, very cheap on the valuations, and they're also improving their business. The ROEs are improving. So we see it as an opportunity. It might not come to fruition now because people want to buy SA-focused exposure, but we see it as increasing as an opportunity in our funds.
I think that's a very good point, actually. Time horizon also matters. And when we manage portfolios, we manage them through the cycle, and we long-term investors. So it's important to take into account that shares move a lot, and there's a lot more volatility over short time periods, but all the portfolio managers have a much longer term view. So thank you for sharing those insights. I'd like to now move away from your underlying portfolios and rather look at what you think it takes to run a successful equity mandate, and also share some of the factors that you believe make you a consistent performer through the cycle. We know that you'll all have short-term periods where you underperform, but what do you think you look at and the way you manage portfolios makes you great equity managers and provides more consistency than some other managers out there? Let's start with you, Etienne.
So, I think for us, our view is there's not one or two things that make you a good manager. We believe there's many different aspects that you have to look at. And if you can do many things just slightly better than everyone else, it'll add up to good performance over time. So it sounds very simple, but if you think about some of those factors, I think one thing, for example, is, as a manager, our people is our biggest asset. So if you can create a culture of where people is motivated and incentivized and can retain your people, I think that's very important for a manager. And then things like being flexible and adaptable. So when things change, I think we always try to do that consciously. When the data change or when the facts change, we try and implement those changes or think about what the impact is on the portfolios, how the portfolio should be changed, should you change your positions. And I think as a manager, it's very easy to get stuck in a view and get stuck in a share, and you got your view, and it's very difficult to deviate from that. But I think we're trying to be open to when the facts change and when the information change, to think about how it impacts the portfolio. So I think that's to be flexible and adaptable to these changes. And I think in South Africa, a country like South Africa, where we're so dependent on commodity prices, the politics can be very volatile. You've got to be open to when the facts change or where the trends change. Things stuff like, I think you have to improve your trading execution, trading costs, just avoiding the bombs, And I think the last one is probably also just to remain humble. So I think as a manager, always when you've had a good few years, you can easily get you think you're great and you've done really well, and it's due to your approach. But the markets will humble you if you don't stay.
I certainly will. Thank you.
So I think it's the one thing that we think makes you a good manager. I think there's many different aspects that we have to work on and be better at.
Thank you. Justin, do you have a similar view or anything you want to add?
I think a lot of those are valid points, and I won't repeat them, but I would just emphasize, we're big believers in process over outcome. There can be a lot of luck in our business, and we're big on a consistent process over time, and being honest about sometimes we get lucky, both good and bad, and being able to separate that from where we did a good job and where the process really worked. So I'd say process over outcome is super important. We're also a big believer in process over period. So you can get short-term periods where things don't work or they go against you, and it's about being able to stick to the process. We structured the business in a way that we can really have a long-term outlook. So everybody is incentivized, and we have a strong balance sheet to make sure that we never feel like we're looking over our shoulders, and we never have to chase short-term performance. And then I think people is so important. We work with really smart, passionate people, hard work, and a long-term outlook. So I think there are three things that we always like to remind people about the way that we manage money. The first is a really long-term outlook. So we own shares in the portfolio on average 10 years. We run very different portfolios, so they don't all look like a benchmark. And we have a preoccupation, an obsession with avoiding capital loss. So that we see as our number one job, is to make sure that we don't lose permanent capital given to us by investors.
Thank you. Junaid?
I largely agree with what Etienne and Justin said. I think sticking to investment philosophy and process, and whatever that is, but stick to it and have the discipline to stick to that. Also, being disciplined in our valuation also. And then I think, in terms of, I think pay close attention to opposing views to avoid overconfidence, because, I think it helps to avoid and minimize, you're going to get things wrong. It helps to avoid getting things wrong and minimize the chances of getting things wrong. So I think that's an important point. And then having the team cohesion, to stick it through. And then I think also, just from our perspective, avoid taking unintended factor and excessive sector bets, because I think it just produces more consistent returns over time, is what we found.
Thank you. Our time's almost up. So I'd like to end off by asking you what you think SA Equities is going to deliver, and where you believe your biggest opportunities are going to lie for this next year. Let's start with you, Justin.
I'm going to say we haven't a clue. We don't spend a lot of time on macro and trying to figure out what's going to happen short term. I do know that because of the outsized performance last year from the precious metals and the size now that they are in the index, and we're looking at multi-decade highs in terms of weighting in the index, what happens with precious metal prices is going to be influential on returns for the coming year. As we've discussed, we don't really have a view on the gold price, but I would say on the PGMs, we were approaching sort of record margins, record share prices, record weighting in the index. It's starting to feel like your risk is more to the downside than further upside. We're also a little bit concerned between the correlation between gold and the platinums. We would far rather see a fundamental demand driver, sort of, as Junaid mentioned, sort of going into autocats. That would make us feel better about the PGMs. Turning to SA, I think Etienne said it very well. We are quite bullish about South Africa. When you sit down and make a list of the positive things that happened over the last year versus the negative, the positive way outweighs the negative stuff, both from a macro and economy point of view. Our politics, the concrete steps in the right direction. It's interesting to us if you look at the difference between, say, the South African long bond versus a developed market long bond like the US or Europe. That premium that you have to pay as the South African government to borrow is at multi-decade lows, which is interesting. It tells you that there is appetite for South African assets, but we haven't seen that yet in the equity market to the same extent, which makes us quite positive on SA in general. We're also believers in not sort of a shotgun approach. We have very specific exposure in the fund to companies that we like and we understand and that we've studied for many, many years. So who knows? But I would say on balance, quite positive.
Great. Junaid?
Yeah, I think, Fluff, going back to the earlier slide that you showed with, returns about 40%, one would think that, after a year of 40%, the return outlook should look a lot lower. But I think it's important to point out that was quite narrow, driven largely by PGMs, NASPers. But I think the domestic side is lagging. And I strongly agree with both Justin and Etienne about the outlook for the domestic side and the domestic-centric companies looking a lot better than we've seen for many years. And valuations, completely agree with Justin. The bond yields at about 8%, but our domestic stocks are trading at one standard deviation cheap, many of them. So we're getting quite excited there, and that's where we've been adding to the likes of, as I said earlier, some of the retailers and we've held lots of banks in the portfolio.
Great.
And worth pointing out also, I mean, we've seen multiple years where foreign capital has left the market. You just need to see that turn slightly, and I think you could get quite an outsized reaction in our market. Our market's quite illiquid. There's not that much to buy. So, I think there's a possibility for some really good returns locally.
Great. Thank you. Etienne, just have last word.
Yes, so we spoke about the macro in SA. We've mentioned those factors. So we are positive in SA. I would maybe highlight, we see it more of opportunity or a window of opportunity in 2026 perhaps, because these benefits we're getting at the moment is very macro driven. So commodity prices, we know, obviously can go up, but can also go down a lot, and then it can reverse. So we see that environment being positive for us, but it's a macro tailwind. We still need to get our own house in order in terms of structural reforms, getting GDP growth to improve, apart from just getting the cyclical benefits. So at the moment, there is steps in the right direction. There are of them, but I think we need to see more of it. So it's heading in the right direction, but it's obviously slower than we would probably would like. So we see opportunity for this year and into 2027. Then you're going into ANC conferences at the end of 2027. I think into 2027, there's going to be a lot of noise in terms of who's going to take over from Cyril, is the GNU going to hold? So I think that risk increases quite a lot in 2027. So we see this opportunity for now. We're in this window of strong tailwinds cyclically, and we want to take advantage of that. So as I said, we like the banks, we like those apps and Investec, like I mentioned. We're still cautious on the discretionary retailers, maybe different to Junaid's view, but something like a PEP, we really like that because I think we've got a better line of sight in terms of their earnings growth. They're not so discretionary retails, but more basic products, and there's many different drivers that they've got to grow earnings, other than maybe some of the discretionary guys who just need top line and macro to improve. So I think that's one that we really like. In the commodity space, similar to these views, we are overweight PGMs over gold. I think gold we are gradually reducing as it goes up because we think there's a lot of positivity in the price. But we're also very positive on copper. We haven't spoken about copper today. So actually, I think that's probably our biggest, our strongest view on the commodity side is on copper.
And why is that?
So long-term fundamentals for that metal is extremely positive. So you've got additional growth or very strong demand drivers from grid capacity that's globally, EVs, battery storage, AI, data centers, all these things need a lot of copper. So we see the copper demand outstripping supply over the next 10 plus years, because supply also takes a very long time to get online. So it's 10 plus years to build a new copper mine. So we've got a very good line of sight on the production, and we think the demand's going to be strong and probably stronger than what people think. And those deficits, we're currently in a slight deficit market this year for the first time in a long time. We think the deficits just continue to increase over the next few years. So we've had a lot of Glencore. We still have a lot of Glencore in our fund, which helped a bit in the last month with the discussions with Rio. But we're still very positive on that sector.
Thank you all for joining the panel today and for giving our viewers a glimpse into why we value you as managers and how different you can sometimes look, but also a little bit of overlap. Thank you. As you can see, managing equities is no easy task. And even with the extensive amount of expertise that these gentlemen here have, there are times where things work against them, whether it's the geopolitical environment, the currency, or even the sectors that they invested in. But by having different weights to different factors, different styles, and combining managers with varying investment philosophies, we at Equilibrium have managed to deliver consistent alpha for our clients. It's not a static process, but rather requires ongoing monitoring. we believe in building resilient portfolios that can withstand whatever shocks are thrown at us. And whilst we tend to buy and hold the underlying funds rather than continuously trading between managers, we do sometimes have to make manager changes. For example, you may have noticed that one of the recent changes we made in our local equity building block is we've increased the exposure to our active managers represented here, and consequently decreased the amount we have in passive and smart beta by downweighting the Momentum Core Equity Fund. And that's because we believe that in the current environment, it's well suited to more active managers, and so this reflects our view as an investment house. Thank you again to our panelists, and thank you to all the viewers for your time. We hope you found it interesting, and please reach out to us if you require any further information.
Thank you, Fluff, Justin, and Etienne, and Junaid. That was an extremely insightful and provides a lens into the various portfolios. Lastly, but certainly not least, we move to our colleague in London. Please welcome Jade Kosh, a portfolio manager from our London MGIM office, who will take us through the global portfolio returns and positioning.
Thank you, Robin. So I'm just going to kick off with this team slide, which I believe you saw last quarter and you are familiar with. So now I'm back, you will see more of me going forwards. But on the side, you can see that this is the portfolio management team. You obviously know Richard Stutley, but we also have Gregoire Sharma, we have Lorenzo Laposta, and then Alex Harvey, who heads up the portfolio management team. So it could be that you see a little bit more from the rest of the team going forwards as well. And just behind the scenes, I think it's worth mentioning that we have a bigger, wider team who are undergoing manager research, quant analyses, things like this. And they all input into not just the team, but also the wider strategy and help in terms of managing the portfolios. So if we take a look at what was happening last year and last quarter in markets, you can see here that returns really were dominated, first of all, by gold, and that's at the line at the top there, but also performance within equities was very strong. But when we look at fixed income, particularly within government bonds, returns was pretty muted. So focusing our attention on gold, Q4 continued the trend that we saw during the rest of 2025, and the gold price increased from about $2,500 per ounce at the beginning of the year to over $4,300 per ounce by December. And that is the biggest annual gain that we've seen in the gold price in over 46 years. And now today, the gold price is nearing the $5,000 per ounce mark. So pretty astonishing numbers. So generally, fund performance for gold tends to follow the gold price. And you can see that on this chart here. So the gold funds within the portfolios did particularly well and contributed to performance. This chart here on the next slide shows gold performance and equities performance over the past 3 years. Now in 2023 and 2024, you can see that returns really were dominated by the Magnificent Seven, and also that fed through to performance of the S&P 500 or US equities. But if you roll forward to 2025, and you can see here that in that sort of fourth group of bars there, gold is really the standout performer. But you can see also that across equities in different regions, performance has been strong as well. So you can see here that global equities ex-US and also emerging market equities have in fact outperformed US equities and the Magnificent Seven cohort as well. So something that we haven't seen in a while, but returns pretty much are a lot more broad brush when it comes to equity markets. And this here just drills down a little bit deeper into that. So performance across global regions, like I said, has been positive through 2025 and also into Q4 as well. So those high bars are 2025, the smaller bars next to them, those are for Q4. And you can see here that performance hasn't just been about Magnificent Seven. It's been about other regions as well. And it's not just because, the focus on US exceptionalism maybe is dimming down a little bit, but it's also because of positive signs for the various regions as well. So within emerging markets, we're seeing signs of improving fundamentals. We're seeing lower leverage at government and corporate levels, de-escalation of trade wars and trade tensions. And then we have the added tailwind of a weakening US dollar, which has made the emerging markets look more attractive to external investors. Then within China, that was the strongest performer in 2025 until we got to Q4 when performance was actually negative. And this is because concerns around the property market returned in Q4. And also investors were locking in some of the profits that they'd seen at the beginning of the year as they came into sort of November, December time. We also had positive performance in UK equities, and that's because there is a healthy percentage in financials within UK equities, and that is a sector that did particularly well. The same can be said for commodity-led sectors, which also performed strongly in Q4, and that benefited the UK. Again, Japanese equities, another positive performer over 2025 and going into Q4 as well. And this is just due to general optimism surrounding the government and corporates in that region. This next slide just shows the same story, but from a different perspective. So we're seeing things from a styles and market cap perspective here. So previously, in previous years, it was all about mega caps. It was all about high growth, and particularly those Magnificent Seven companies, which we have mentioned a lot. But this time round in 2025 and going into Q4 as well, returns have been much more broad brush, and we had strong returns across sectors, across different market caps and styles. And you can see particular strength has come from value and small caps, as well as the sort of larger caps and growth style segments of the market as well. And with positive performance across equity markets, this also means that valuations are pushed up across the different regions as well. Now, the US is the standout region here. You can see that from the line at the top of this chart. We don't think that valuations are in bubble territory yet, but we do feel that it's really important to be particularly selective and diversify when it comes to your allocation, because some valuations in the US are looking quite stretched at this point. Across other regions, like the UK and Japan, we think, valuations have risen since the lows of 2022, but we think that there is further to go here. So there is still more upside in a lot of regions, and even within pockets within the US. So turning our attention to fixed income now. Firstly, within the US, returns were pretty muted. We saw the yield curve steepening as short-term interest rate-driven parts of the curve were driven down by rate cuts. And we also saw rising yields in the longer maturities of the curve there as well. A standout performer in the space was the UK in terms of government bonds and corporate bonds. And this is because, firstly, we saw rate cuts in the UK, but also in the UK, we had our budget announcement. And the budget was pretty well received, and this is because of a lower than expected reliance on debt issuance in the region. And this was all positively perceived by the asset class in the UK. Turning to emerging market bonds, that was another positive performer during Q4, and the region benefited from improving fundamentals and again a weakening US dollar, which was beneficial for the asset class. Japan was the one region where we actually had disappointing performance within fixed income. And this is because investors are getting increasingly concerned about the debt burden of the country. And this is made worse by the Prime Minister's announcement of a 21.3 trillion yen fiscal stimulus package. And this is at a time when Japan are in fact raising interest rates. So it's not a good time to be particularly leveraged. So overall, a mixed quarter for fixed income, but not a very exciting one all in all for fixed income. So as it's the start of a new year, I thought it would be good to touch on our outlook for 2026. We're seeing a lot of geopolitical risks globally, and the flags on this world map demonstrate some of the wars and some of the stress points that we're seeing today. And this is only getting worse and intensifying as we've seen coming into January as well. That said, these events have had minimal effects on markets, and where there has been an impact on markets, it has been somewhat short-lived, and then we've seen a recovery in the months or even days following the event. The only area where we've seen a long-term impact seems to be on the gold price and other precious metal prices, where these are safe haven assets, and investors have put money into those assets, and governments have been buying up gold and precious metals, therefore pushing up the price, and that's having a longer-term effect. As well as these geopolitical risks, we're also seeing other risks. For example, the risk of trade wars, the risk of increased tariffs, which US President Donald Trump has brought up again in recent weeks. But then he has also backtracked in the last few days on this again. So it's just that we have risks that are popping up, and we don't know sort of the impact on markets and how long it will affect markets. And despite these risks, investors are still bullish. You can see from this chart here that bullishness is almost at peak levels. This chart shows growth expectations for equities and cash, with 10 being the most bullish and 0 being the most bearish. And at the end of December 2025, investors' expectations for growth were around an 8 out of 10. So risk appetite was particularly high after a short-lived dip earlier in the year. So this just means that there is room for disappointment, because we have all of these risks. We have investor sentiment at peak levels or near peak levels. So yes, there's room for disappointment, but it does also mean that it does open up some opportunity as well for other investors. And investor bullishness is in fact showing up in equity market performance. And this is across various different regions. So not just within the US, but also in emerging markets, and the UK, Japan. So it's pretty much been a broad brush positive performance for equities in 2025, for example, as we move away from US technology. And that's as investors are sort of moving away from US exceptionalism, but also as there's more positive sentiment around other regions as well. And we believe that this is going to continue for various reasons. First of all, there's a lot of uncertainty surrounding the US President Donald Trump's various unpredictable actions. We don't know what he's going to announce. We don't know if he's going to impose tariffs on countries again, and whether he's going to backtrack on some of the things that he comes out with. And this obviously does pose a risk to markets. But as I said, it is often a short-lived impact on markets, but it does still pose a risk because there's uncertainty there. And then when we look at valuations within the US, they are elevated relative to other regions. So although we don't think we're in bubble territory when it comes to the US valuations are elevated relative to other regions. And so there is just farther to fall if we do see a market downturn. And then lastly, as you can see from this slide, US debt levels are at record high levels at the moment, and this is at a time when interest rates remain slightly elevated. And interest rates are slightly elevated, and we believe that there's little room for further cuts in the US. So it's unlikely that interest rates are going to come down significantly from where we are today. We think that this is also the case for the UK and Europe as well, so not just the US. And then in Japan, they're actually hiking interest rates as well. So just an environment that we need to watch. And one of the key reasons we think that interest rates are unlikely to come down significantly from here is because, as you can see on this slide, inflation has normalized, but it has normalized at the higher end of the ranges. So if we start to see inflation picking up again from here, or if it doesn't continue to trend downwards, again, it's unlikely that we're going to see many more interest rate cuts, or we could even start to see interest rate hikes if inflation starts to creep back a bit as well. So we think it is worth looking at other areas within the fixed income asset class. For example, corporate bonds we think look slightly more attractive than government bonds today. and then also emerging market debt. So as you can see from this next slide, this chart shows that the quality of bonds within the emerging market space has in fact increased significantly in recent years. And that's because the region's benefited from things like monetary easing, from falling inflation, and also a weak US dollar. And that's really benefited those emerging market countries. And this is an area that we've really been focusing our attention on lately, looking at underlying exposures within the portfolios and also looking at our fund lineup and exposure within the space. So just a recap on our outlook for 2026. There are geopolitical risks everywhere. However, despite this, investors are very bullish. And this presents both risks, but it also presents opportunities. As a result of all of these risks, precious metals have strongly outperformed over the last year or so, and we're continuing to see that. However, there is a risk that they fall from these peak levels, so we need to be mindful of that as well. We remain risk on, but we are selectively risk on. So currently, we have particular conviction in quality, defensive, and small cap equities. We believe that the rotation away from US technology will continue, and overall we favour Japan and emerging markets for the reasons that have been mentioned. We see good upside potential in those regions. Within fixed income, there's little room for more rate cuts, and we think that inflation has more normalised, but at the higher end of the range. So therefore, we're looking at diversifying exposure within that area to other more interesting parts of the asset class, like emerging market debt, and also outside of the asset class, we're looking at areas like specialist assets, for example. And onto the portfolios. So this slide here is just a reminder of the three different portfolios and the asset class makeup of them. So first of all, we have the lower risk portfolio, which is a typical 30-70 allocation to equities and then bonds and other diversifying assets. The medium risk portfolio in the middle there, which is a 60-40 portfolio with 60% in equities, 40% in bonds and other diversifiers. And then the higher risk portfolio on the right-hand side there, which is about 90% in equities and 10% in bonds and other assets. This slide here just shows longer-term performance in the US dollar terms. So you can see the solid lines there depict the portfolio performance relative to the targets, which are those dotted lines. And over the longer time period, you can see that all three portfolios are outperforming their targets. The next slide is a little bit more of the same, but in ZAR terms. And you can see here that the performance differential between the portfolios and those targets is a little bit wider, which is obviously a positive. This has come off a little bit at the back end of 2025, which you can see with those portfolios sort of pointed down a little bit there. And the reason for that is the weakening of the US dollar. Now we're going to zoom in a little bit in terms of performance. You can see here that over the recommended holding periods for the three portfolios, that's over 3, 5, and 7 years for the lower, medium, and higher risk portfolios respectively, that all three portfolios have outperformed or broadly in line with their cash plus targets. Over the 1 year period, you can see that all three portfolios have generated strong positive performance. And that's because of the gold allocations and also because equities have had a very strong year in 2025. Now turning our attention to the fourth quarter of 2025, you can see here that the portfolios have outperformed or were broadly in line with their targets over the period. And we're going to dig a little bit deeper into that. So first of all, the lower risk portfolio shown here, you can see that the portfolio, again, outperformed its cash plus 2.5% target and was also ahead of a typical 30-70 equity bond portfolio. Manager selection was broadly neutral in terms of the effect on relative performance there. However, it was asset allocation that contributed nicely to performance, and that's particularly due to the allocation to gold, as mentioned, but also due to the overweight to higher risk, shorter dated bonds in the portfolio. Next, we have the medium risk portfolio. You can see here that the portfolio outperformed its cash plus 4% target, but it did underperform a typical 60-40 equity bond portfolio. Now, Manager selection again detracted. It detracted by a little bit more in this portfolio because there was a higher allocation to equities, which lagged the benchmark, and I'll come on to that a little bit later. And then in terms of asset allocation, that again contributed nicely. So the same reason as the more cautious portfolio is that allocation to gold, and then also the overweight to higher risk, shorter dated bonds as well, which did contribute. Lastly, we've had the high risk portfolio here. So again, the portfolio was broadly in line with the cash plus 5.5% target over the quarter, but it did underperform a typical 90-10 equity bond portfolio. Now, it's a similar theme to that medium risk portfolio that we just looked at. The higher weights of equities meant that was the biggest detractor, particularly within the manager selection area. And then we had a minimal positive effect from asset allocation because there's a smaller allocation to gold. It's just 1%. And then there's also, of course, a smaller allocation to fixed income and therefore a smaller allocation to shorter dated bonds. So that wasn't really enough to offset a negative performance from the manager selection within equities. Now, turning to underlying manager returns, so the standout performer, as mentioned, has been gold, and that really benefited the portfolios. It had a bigger effect in the lower and medium risk portfolios because they are bigger allocations, whereas in the growth portfolio and the high risk portfolio, there is a smaller allocation, so it had an effect, but just to a smaller degree. There's not too much more to say on fixed income. As I mentioned, it was those shorter dated, higher risk bonds that outperformed, whereas government bonds returns were very muted over the quarter. And this is reflected in the aggregate bond portfolios that we hold within these portfolios. Particularly something like Dodge & Cox has a 50% allocation to high yield and emerging market debt, and that was additive to the three portfolios, particularly where that allocation is a little bit higher in the lower and medium risk portfolios. Within equities, there's a bit more of a mixed bag. So first of all, in the emerging market space, so Fidelity was really the standout performer here. It was strong stock selection within China and South Korea that really benefited returns. But then we saw negative performance coming from Coronation, for example, and that was a detractor to the portfolios. Turning our attention to the global equity fund, again, it's quite a mixed bag within there. So on the positive side, we have, for example, the Artisan Global Value Fund, which is overweight financials, and that really was a contributor to performance. And then we have the Morant Right Japanese Equity Fund, which also did very well, and that's due to optimism surrounding both the government and corporates in Japan, and that was a nice tailwind for that portfolio. Unfortunately, on the other side of this, we have negative performance coming from our quality style equity fund. So that's the Robeco quality fund, and then also the Even Load Global Equity Fund, which has a quality bias. And generally, quality funds have had a tricky time over the last couple of years. And this was the same story in Q4, where those sort of more robust, or usually robust ballast stocks, didn't hold up relative to other areas of the market. The allocations to these policy managers are bigger than those to some of the positive areas. So unfortunately, overall, the allocation in equities did underperform on a relative basis. So overall, a mixed quarter in terms of fund performance, but we are comfortable and we're happy with where we are, and we're positive on our longer term performance.
Thank you, Jade. That wraps up our quarterly bulletin for the day. Thank you for spending the time with us today and for your continued support. We truly appreciate the ongoing engagement and hope the ideas and thoughts shared were both useful and relevant for you and your clients. If any questions come up, or if you'd like to chat further about how our solutions can support your advisory practice, please feel free to reach out at any time. Our investment specialists and portfolio managers are always happy to help. We look forward to connecting again next quarter. Until then, thank you once again and take care.